An investor's take on this recent sell-off. Joining us now is Dan Suzuki, Bernstein Advisors Deputy CIO. Dan, good morning. It's more than just a little volatility. It's been an unusually persistent 3-week downtrend here in the indexes. What's your read on what mainly is driving it, and how do you react to it?
Yeah, Mike, I think, a lot of dovetailing off a lot of what you just talked about. I think really what you're seeing is, pricing in of uncertainty and then the negative impact that that's having on sentiment. And if you sort of analyze what's happened in markets, you can almost draw a straight line through everything that's happened based on, a few things. One is if you just looked at what things rallied the most post-election up until mid-February, and you look at what's gone down since mid-February, it's almost a mirror image of each other. Also, another way to look at it is the things that have gone down the most have been the most expensive and the most high beta things. And so that makes sense if what you're doing is pricing in an uncertainty risk premium. The things that have bigger valuations are going to get hit harder, as those risk premiums go up. So I think that's the main thing driving markets. But to what you said earlier, Mike, I think the hard data is actually still holding up quite well. So to the extent that we do get some relief, on the headline front, you can see some of that uncertainty premium come out.
But isn't the danger, Dan? I mean, we've just had a surprise drop in retail sales. Personal spending was a disappointment. I mean, the thinking was, it might be weather. Let's see if it's ratified in February and March. But still a possibility, is it not?
Yeah, of course. The longer this goes on, the more that the soft data and the negative sentiment starts to affect real spending decisions. And I think we're at that point where that's just starting to happen. So if this goes on for another month, which it very well could, that's where you probably start to see it hit the data. But I think, the January seasonality in the data, the weather, the fires, everything else, I think was very distortionary, let alone that's a smaller spending month for retail. If you look at some of the faster, the weekly retail sales data, it's actually pretty resilient right here, along with many of the other leading indicators. Within the jobs report that Melissa mentioned, manufacturing hours worked is basically, sitting at like a 2-year high. Jobless claims, which we got earlier in the week yesterday, still very strong. So I think the economy is not falling apart, but the longer this goes on, I totally agree, Carl, that this is going to weigh on growth.
How do you, Dan, interpret all the comments that we've gotten from retail CEOs of late? I mean, I'm thinking of Costco. They have a very wealthy consumer, and Costco is talking about the consumer being very choiceful and trading down in terms of the cost of protein. They're buying ground meat instead of, more expensive beef. They're buying poultry. Messages like that. And at the same time, you have Dollar General on the other end of the spectrum saying they're selling more consumables, which means that they're seeing a trade down from another retailer to buy cheaper consumables at their locations. And so that data the commentary is much more real time than a lot of these backward looking sort of data points like CPI and jobs, et cetera. So how do you forecast that into where we are in this pullback and what the risk premium should be?
Yeah, Melissa, I think that, if you look at the main reason that a lot of these retail and consumer-oriented companies have gotten hit, it's probably more to do with disappointing guidance. And I think that's a reflection of the same things that are hitting these surveys in terms of expectations. Now, the activity that they're seeing in terms of trade downs, I think that also makes sense if you think about what's happening, to the consumer in real time. I mean, there's a wealth effect, and, the stock market's worth 10% less than it was, especially if you're in the more crowded names. Maybe your wealth is down even more than that. There are certainly struggles, especially with persistently high inflation. So again, the longer this goes on, the more that you're going to hear that commentary flow through to spending decisions. But in terms of the risk premium for markets, I think, the markets are really adjusting to what's likely to be a very persistent ongoing level of heightened uncertainty. And even if we do get some relief on the headlines, which I'm anticipating we probably will, within the next month or two, you'll probably see that uncertainty come down, that just the elevated level of uncertainty needs to continue to be priced in, which means you're probably not going back to the 22, 23 times multiples that we saw, at the start of the year.
Yeah, and maybe, keeping folks looking at the value sector, which has outperformed quite a bit on a year-to-date basis. Dan, great to talk to you today. Thank you very much.